What does it mean when a corporation pays dividends? Well, simply put, it's the corporation sharing its profits with the owners, the stockholders. But why would a corporation share its profits? Why wouldn't a corporation keep all that lovely money for themselves? Let's explore that. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and my sidekick, Terrence, and I are here to put the fun in accounting fundamentals. Now, let's say our pretend corporation, Terrence Inc., has a banner year, lots of profit. The board of directors meets to discuss whether some of that profit should be shared with the stockholders. But wait, some of the profit? Why wouldn't the corporation share all of the profit? Because profit has to be used first to pay debt principal and to invest in things like equipment and buildings and to develop new markets to sell our products. Giving away all the profits would weaken the company. But we also want to make our stockholders happy, and that's why we don't hold on to all of the lovely profits. We want to reward our stockholders for investing in the company, and we want to make sure that they want to continue to hang out with us. So whenever it makes sense to do so, we want to give them a dividend, a share of the profit. But what if Terrence Inc. had a terrible year? What if there was no profit? Well, if there isn't any profit, there's nothing to share with the stockholders. What does that do to the market price of Terrence Inc.'s stock? Well, it may drive down the price of the stock because the stock doesn't pay a dividend, so it may be less attractive than a stock that does. And also, it may give a sign to the market that something is going wrong over at Terrence Inc., and we probably should get rid of our shares today. Well, what if Terrence Inc. had a good profit, but the board of directors decides that it makes the most sense to hold on to the cash because of business growth plans, or there's a bond that's maturing, or market conditions. So it can opt to do a stock dividend rather than a cash dividend. So the way the stock dividend works is that for every share of stock that you own, you'll receive a percent of an additional share. So for example, a 5% stock dividend means that for each share you own, you'll receive 5% of another share. So if you own 100 shares, you'll now have 105 shares. Now, if you're watching this video because you're taking an accounting class, stock transactions may trip you up. But do not worry, because Terrence and I have your back. We've done your homework for you. You're welcome. So for more in-depth information about stocks and paid-in capital and dividends and all the journal entries you need to ace your accounting homework, jump on over to the Accounting How To website. The link is in the description, but it's easy to find. It's accountinghowto.com. Until next time, stay balanced, my friends.